Hi, everybody. This is Nat Tamariz back with the Raise.com Top Capital Raiser Show. And today I'm joined by a fantastic guest. His name is Seth Bradley. And Seth is with a portfolio of firms that he runs. And one of the main firms he focuses on is Raise Law, which is a securities firm that assists real estate operators, GPs, and people in the real estate world to prepare their offerings compliantly so that they're able to legally and compliantly raise capital. You know, as Seth is a extremely experienced securities attorney, IT experts, an entrepreneur. We're going to have a wide range of discussion about what's up next for the future of capital raising in real estate. So, Seth, it's amazing to have you here.
Absolutely, brother. Natu, thanks so much for having me on the show. I mean, folks that are like new to the industry, I mean, they can't even understand what we're saying, right? Like they come in and like, what are all these terms and acronyms? And it gets even worse because like you said, people will use the same term for different things. So you have to actually ask them like, what do you mean? Tell me how you're using that word. When I say fund to fund though, it is what it is, right? It's a fund of fund. You create your own fund and you take the aggregate capital that you collect into that fund and invest in another fund or another syndication. And that's the key there. So you basically got two securities, right? You've got your fund that you set up, and then you're taking that capital and investing in somebody else's fund or syndication, as opposed to the other way around, which would be you take your capital and invest directly into the asset. So you're buying the real estate or buying the business, whatever that looks like. But instead of that, you're actually buying membership interest or shares into another company that's actually buying the asset, buying the real estate, buying the business.
Okay, makes a lot of sense. So, yeah, because I mean, on our side, we see people, just for context, a lot of what we do is on the mergers and acquisition side, business acquisition side lately. But we see some people, so I guess stage one, they own their own real estate. So kind of like you when you were starting, stage one, fix and flip, they own their own real estate. Stage two, like maybe they get a lender and they get a little bit more leverage. Stage three is, okay, there's an equity gap. I want to buy that multifamily deal and then I don't have the equity. So I would, issue a 506C Regulation B, or even 506B if I have a personal relationship, and try to find some accredited investors to partner with me to, so I own that asset. So that's the asset that I own. So you're saying that this stage is, okay, I have another person's deal that I want to raise money for, instead of it being my asset that I own. Is that correct? Just to make sure.
Yeah, that's correct. And you're seeing more and more of that nowadays. So if you were to rewound this to, let's say, 5 years ago, these same folks that are doing the fund of funds were probably co-GPs, right? Like we used to call them co-GPs. We still call them co-GPs, but it's kind of become a thing that, something you don't necessarily say because you're either a GP or you're not. There really shouldn't be this other role called a co-GP, because essentially what it turns out to be is that you're just raising capital and you're not really doing anything else. And that's illegal. That is non-compliant. There, that rule got abused. We're entrepreneurs. We push the cards. We always just try to keep taking a little bit more and taking a little bit more. And, a GP structure or a co-GP structure in its theory, it makes sense, right? Like everybody's pitching in, everybody's doing something, everybody's taking an active part in the deal. But what it turned into was like, hey, let's bring in 5 co-GPs. Let's bring in 10, 15. I saw like 20 co-GPs in some deals at a time. And it's like, well, what are you actually doing? Well, you're raising capital. And a lot of times you're getting paid just to raise capital, and you're getting paid based on how much capital you raise, which is even worse. That's transaction-based compensation. Can't do that unless you're a broker dealer. Just like I can't practice law unless I have a law license. You can't raise capital without a license unless you find an exemption. And that exemption is blown when you're just raising capital, charging transaction-based comp, and not doing anything else, not really taking another active role. But those folks now have come around, and now we found a more compliant way to do things, which is the fund of funds route. So you create your own fund. So you're your own issuer. You're the active partner in your own deal. And we're seeing that more and more. And we're actually seeing that too. A lot of lead sponsors that are the ones buying the assets, they're recruiting these folks. Yeah. They're recruiting these fund of fund managers to be part of kind of their team, inviting them to say, check out my deal. you want to raise capital for me, you're going to start your own fund of fund, and then you're going to invest passively into my deals. And folks are like, people are getting tons of momentum doing this. I mean, you're seeing like, these special events where they're getting wooed and taking them to nice dinners and, taking them to, football games and things like that. So it's kind of this whole new market that's developing.
When did you see this market develop? Because, one thing, I'm just going to get this out of the way. Like, I mean, you're a super experienced attorney. I mean, you're in California. You have your cap backwards, the guitars on the background. Like, you're very unconventional, and you're more experienced than a lot of people that I've seen wearing a suit in New York City with a fake Rolex. So, right. So the thing is, what's my question is like, so when it came to finding this niche, how did you identify this growing trend? Because I mean, it takes a lot of it's more than just a simple business here. It takes a lot of four-dimensional chess playing to come up with this, right? So because you definitely saw something many people didn't. So.
Yeah, I mean, it came down to, the SEC was actually cracking down on this a few years ago. So they were examining these sponsors that were abusing this co-GP kind of rule or this structure. And people were getting interviewed, and eventually not too many people actually got in trouble for it, but they did get interviewed by the SEC. They were getting questioned. They brought their co-GPs in, things like that, to interview them. So it got around. So this is a small industry, really, when you get into it, Natu, that everybody knows everybody, and everybody found out about that. And they said, well, shit, what do we do? Right. Because we still need that capital. We still need this place for, capital raisers to be part of the deal, because lead sponsors maybe are trying to scale and they're having trouble raising all the capital themselves. So what's the answer? Like, what do we do instead of this co-GP structure? And the answer has actually always been fund of funds. Fund of funds is not new. It's been used in private equity for decades, right? But it hasn't necessarily been used in this industry in this way. Because it's expensive, right? It's expensive, it's time consuming, it's complicated. You have to find all these things that the lead sponsor used to do for you. You have to find a securities attorney, you have to find a CPA, you have to pick an investor portal, you have to do all the simple things like open a business banking account and file for your LLC and get an EIN number. All the things that the lead sponsor used to do for you, you have to do yourself now. And you have to form your own funds. So that's expensive, right? You get your own securities attorney. Maybe they're going to charge you $15,000 to, when I worked at a large law firm, we used to charge $75,000 to $100,000. So anywhere from $15,000 to $100,000 plus to set up this fund. It's expensive, it's time consuming, it's complicated. And for some of these folks that are just raising, $500,000 to $2 million per deal, it's like, it doesn't even make sense, right? It's not worth, the juice isn't worth the squeeze. But that's where I saw a gap in the industry. And luckily, I was actually speaking at an event with the CEO of TribeVest in, when was that, July of 2020, I want to say 2023. And he was trying to pivot his company from a group investing platform, which is traditionally what TribeVest used to do, into the capital raiser side, right? Like, all these folks that were putting these groups together, these group investments together, started saying, look, I'm doing all the work, right? Somebody in that group is doing all the work, getting all the people together, organizing them, and they want to get paid for their services. Well, how can you do that? Not through a group investing platform. You can't do it that way. So how do you do it? We're getting into the securities world. We have to do something else. So maybe it's a co-GP, maybe it's a fund of fund. Obviously, we already talked about people moving away from the co-GP route at that point in time. So I said, look, Travis, like, if you want to get into that world or into this world, fund of fund is where it's going. We just got to figure it out.